Hello, everyone. My name is Robin Dolezal. Today is September 13th. With me, as always, are my good friends Alex Pars and Dan Nentel. Together, we are with Ironwood Financial. Good morning, gentlemen.
Morning.
Good morning.
How you feeling, Dano?
Well, except for the inflationary number, pretty good.
Okay, good. Yeah, I know Dano was not feeling well this earlier this week, but I hope he's feeling better. All right, so we got a lot to talk about today. Alex, I just saw an interesting article though that there was a big shipment trying to cross our border. Can you tell me a little bit more about that?
Yeah, so the Customs and Border Protection seized a very large shipment coming across the border into the U.S. And upon inspecting the car, they realized that it was more than was going to be used for individual use. So clearly it was commercial. So thankfully, they caught this person and they confiscated and destroyed the goods. So now we don't have to worry about them being spread around on our streets.
Right, and this was
making their way to the public. Who knows what they could do in the wrong hands?
Yeah, this was marijuana, I assume, right?
No, it's cheese.
Oh, cheese.
Yes, something like 60 wheels of cheese. So thankfully kept out of the wrong hands.
Right.
Keep all the arteries that have been saved.
That's funny. Okay, we'll get to it, Dano. I know Dano loves our quirky little stories.
No, I was laughing that she declared 10 of them and tried to hide the other 50.
Right. Yeah. All right. So before we get to today's numbers, I'm going to give you guys the year-to-date numbers. It looks like the S&P so far, it looks like year-to-date is down about 17%. NASDAQ obviously is worse. We're down about 25%. Mids and smalls respectively down about 14 and 18, and internationals getting beat down a little bit too. They're down about 23% year-to-date. Let's talk about today's numbers, Dano. I'm sure it's all green, right?
Well, if you got up and watched the futures before about 5:45, it was a very nice day. And then they announced the inflationary numbers and a couple of different parameters, and the market really panicked. It's kind of funny, Alex and I talked this morning. Almost everyone priced in that the Fed on September 21st, when they have their two-day meeting, announced on the 21st that they were going to do about a 75 basis point or 0.75% increase, which would be the second, Alex, you and I keep debating, or is this the third? The third one.
Will be the third, yeah.
But it was priced in literally last week. If they only do 75 basis points, that's gonna be outstanding. The worry now is the numbers came in worse than expected, and maybe the Fed will maybe push down a 1% or 100 basis point increase. It's not priced into the market for that, so maybe they're pricing it in now. Reality is we're still not where we were in June as far as the market bottoms. If that is the bottom, Alex hates it when I say that we may have hit bottom, but I still think we have.
I like when you say it. I mean,
hey, and so far I've been right. June 14th.
Right.
We've been pretty consistent in this one theme. Now, granted, we haven't had one of these videos since the first part of August, but the one thing we thought was, with low volume, with the election coming up, we're going to continue to see volatility that's going to be pretty tremendous. I imagine that'll probably take us all the way through September. And then, of course, we do have another Fed meeting in November and then another one in December. But the difference is we'll have all the minutiae of the election going on. And I think we talked about this maybe when we last talked, but we are now setting records on the amount of money being spent on the political campaigns. So normally that means it takes everyone's minds off the market a little bit, and we should historically have a decent fourth quarter, but we'll have to see what happens. The Fed is obviously the most controlling aspect of the markets right now.
Sure. Yeah. All right. So Alex, tell us, what were the numbers today that came out?
So the hope was that we would see negative headline inflation for the month of August by negative 0.1. Instead, we got 0.1 to the positive, which when you look at it, that's not that bad. We're talking well within the 2% target range of the Fed. So at first glance, that looks like a good thing. Unfortunately, that was because of a 10% decrease in fuel prices. So if you remove fuel and food and use the core CPI number, we came in at 0.6, which points us to closer to a 7.5% annualized rate.
Yeah.
Which is, again, well outside the range we're hoping for. So the problem with that is, 2 weeks ago, we got really big job numbers. We were hoping to see job openings decline because they were at something like 11.5 million in March. They'd gotten down into the tens. We were hoping for 9 maybe, and we jumped back up to 11.
Yeah.
So we have more job openings. We still have 4.5 million people a month quitting their jobs in search of a better one. What's that mean? It means they're probably getting paid more, which means they have more money to spend, which means we see inflation. So, so far the cycle has not been broken, and the Fed is diligently working at, making sure that those numbers go down. However, with today's, numbers, chances are we're seeing at least a 0.75 hike on next Wednesday.
I know you want them to just to keep sitting on their hands and wait to see what those other numbers have done throughout the rest of the year. What do you think they're going to do? Obviously, let's just assume they're going to do 3/4 of a point. What does your gut tell you they're going to do throughout the rest of the year? Because we've got September, November, and December that they meet.
Yeah, the challenge is the core CPI is heavily weighted towards rents, basically. So they take out things like gas. So we'll probably see a negative headline CPI again for September because gas prices have come down again. But if rents continue to go up, then, and the reason those would continue to go up is because they lag. And so people who haven't raised their rents for the last 11 months because they were locked into a lease now have the opportunity to do that. And they're hearing about how all these other rents are going up. So they're probably trying to do that across the board. So we could see a continued upward pressure for several months at least because of that lag to lease due to leases.
So now here's the funny part about that, because we're in this weird world right now where the market likes bad news, right? So if we find out a bunch of people lost their job, just like Chairman Powell said, I would rather see us get a control of inflation and I'm okay with people losing their job. So as rents go up, people can't afford as many goods, and it probably will provide bad news for the market, which actually could be a good thing sometime mid-October. The market is kind of disconnected right now.
Yeah.
Right, and there's actually a good chart I'll show you here, which is a survey that the Bank of America does, and they've been doing this for years. So if you look at this, back to 2006, every quarter they're doing this, or every month they're doing this survey, and you'll notice this is how scared people are. Basically, what chance does the public think that there's going to be a recession? Well, what's interesting to see is it's pretty generally around here, and then boom, March of 09, market bottom, April of 20, market bottom. We're not quite to that level, but we're pretty elevated.
Right.
So this could be a very good indication that, investors have given up the ghost, which typically means the market's ready to rally. And so the article also continues to say there's record amounts of money sitting in cash, lowered exposure to European equities, things like that. Then so again, all those, like Dan said, bad news is good news, lead us to believe that this could be, good things in the near future.
Yeah. To help sell the story, Dano, that June might have been our bottom, huh?
That's right. But the difference between now and June is you're not afraid to put money into bonds.
Yeah.
If
So
you
what
were
I
to
know
look
bonds are
at-
doing, so what are we looking at bond wise? What are they?
Actually, we were all looking at this not too long ago, but right now you don't need to go out very far. You can go out 3 or 4 years at most. You can diversify amongst a couple hundred different bonds, and you can diversify between high quality and high yield, and you can easily get around a 6% yield for not a long time for maturity. Most people, I was listening to a person from Morgan Stanley, and they said, now is the time for you to start buying your bonds. If you're sitting in cash, buy your bonds, be patient. But then at the same time, I think about that, and I'm like, okay, do we want to lock in a 6 to 6.5% yield if we think we're close to the bottom? That's why you use a diversified portfolio. You probably do want to drip into some equities, buy your bonds, have them, they're going to raise interest rates again for sure this, in next Wednesday. I would say for sure again in November. They're not going to do interest rate raises like they did in 1980 with Volcker, but they'll probably raise something. And so the concept would be diversify, drip into equities, feel free to buy your bonds, and you're actually going to be okay with it.
Yeah.
And a lot of the bond pricing, remember, they're forward looking just like stocks. So everybody in the bond market is thinking what you just said, which is they're going to raise rates a few more times. So as long as we don't get surprises, then they should already be priced in. You know, I'm looking at a, 2026, high yield fund paying 8% plus to maturity at this point.
Yeah, that's great.
That's not where interest rates are today. That's the anticipation of future hikes built in.
Mhm.
So,
Yeah, I mean, it looks like the 10-year is currently at 3.44. Obviously, it's up today.
Yep.
So that's goes to show you yields are going up. I wonder, I haven't even looked today, but 30-year mortgage, do you think that's kind of pegged at 6? I mean, it seems like it keeps hitting 6 and then doesn't go above that, but I wonder
Funny,
if that
I'm
continues.
actually looking at a headline. It's actually saying that it's at a 14-year high today because they priced it in. Now remember how the banks work. If they think there's going to be a 75 basis point increase in the overnight Fed's fund rate, they grab it all right now and raise it. And then when they only do 75 basis points, mortgage rates will start to go down. So,
but at least you get more
Notice
on
you
your
get
savings
cookies.
account.
what's that?
At least you get more on your savings account. I mean, that's
Yeah, that
it's
seems
probably
like
up to
behind.
0.5% by now.
Yeah.
Okay, so I don't know if you see a rate, Dano. I just looked one up, 30-year fixed 6.8. So that is an increase. I don't know. Anyway, interesting.
But realize just about 3 weeks ago is at like 4.9.
Yep.
And
Yeah,
what did they do?
and I mean, relatively, right, for the last 5 years, it's still not bad. So
Right.
All right, so Alex, what are we looking for next? What's our next indicator?
We're looking for inflation to come down. We're looking for fewer open jobs.
Yep.
As long as I can quit my job today and have a new job tomorrow with better pay and benefits or name it. Here's a good story David told me about one of his neighbors. He said his neighbor who just got out of school got a job making $30,000 about a year ago. But he didn't take his resume down, left it up, and kept going on interviews. So he'd update his resume with the experience he's been getting for the last year. So he's on, I think, his 4th job now, making $120 a year. So just because the demand in the market is so high for anybody. So
that sounds exhausting to me. Four jobs a year.
Yeah, look at the pay increase. I mean, and people wonder why there's inflation. I mean,
right.
You're starting to see banks and tech companies start to lay people off because they're kind of getting ready for the next run up.
Yeah, interesting. All right, cool. All right, Alex, you're going to put together a market report for everybody to read. And we'll do this again in what, I don't know, probably a month or so. Folks, if you've missed any of our other videos, you can watch them on our Facebook page. If there was a question that you were hoping we were going to address today and we didn't, please email us. Let us know what that is. We'll get back to you. If you are not a client of ours, but you'd like to brainstorm with us, feel free to give us a call. You can reach us at 888-271-4646. Other than that, gentlemen, always good to see you. We'll take care and we'll see you next time.
all right, take care.
Thanks, guys.